You think March is the first go date for higher rates?
Yeah, I do. I do. And I think, from market pricing, you can see that markets expect that as well. So as you put it, the Fed doesn't really need to hit the markets over the head by signaling this March hike. What they need to do is just deliver on that expectation.
And what do you mean by deliver? What would threading the market needle perfectly look like for Jay Powell and company? What do they need to... We know what they're probably going to do. What do they need to say? It's the words that matter, Ellen, as you know.
Yeah, so I think in the statement itself, they need to basically say, we're knocking on the door of full employment. We've met our mandates, and it will soon be appropriate to begin lifting rates. I think what they avoid saying is just as important as what they do say. And that is that I think that they'll avoid using the words measured or gradual, because that is taken as a guarantee of the pace. And that's what they need to remain flexible on. And so measured is that 25 basis points every meeting that was used back in 2004. Gradual is every other meeting, so at those 4 major meetings a year. But they don't know when they're going to deliver the hikes, at which meeting. So you want ultimate flexibility. So Chair Powell in the Q&A can remind us that every meeting is live. So what they're telling us at this week's meeting is simply, look, we're going to start hiking in March, but we don't know how many and we don't know when.
And there is, Ellen, a lot of talk about a more hawkish Fed. You've heard the numbers. Some people say 4 rate hikes. You got some people on the street saying 8 or 9, whatever it may be. Here's what I haven't heard anybody talk about, is national debt. When interest rates go up, it costs more for the U.S. government, i.e. taxpayers, i.e. all of our viewers and listeners right now, to pay those interest payments. We have never had debt like this. We've added trillions in debt since the last rate hike cycle in 2018. Is there a level of hawkishness they can only get to, even if they wanted to go more aggressive, Ellen, because the U.S. government could never pay the debt?
So it's a good question, Brian. I do get that question quite often. The way I would view it is that the higher the debt as a share of our economy, the lower the neutral rate in the U.S. And so what that means is, it doesn't mean that the Fed can't raise rates at all. It means that every 25 basis point hike they deliver is that much more impactful. And so it argues for a gradual removal of policy accommodation. And it requires Chair Powell, as he's reminded us, it requires a very lengthy cycle. Now he's looking for something, on the order of 10 years plus, as the last 2 cycles have been. I don't think we're going to get as long of a cycle. And so I don't know that the Fed's going to be able to get as far off of zero as they'd like. But if you do it in a predictable way, be very flexible and stretch the cycle so you have a long time to lift rates, then you will get them as far as you can. But debt is that moderating factor of how far you can go.